Well, hello, everyone. Welcome. I am so glad to see everybody here. I am very excited to launch this. Hey, everybody. Is my microphone working? Can you hear me? Yes, no? Can we maybe turn it up a little bit? All right. We got to make sure everyone stays awake because we're going to talk about an exciting topic. We're talking about economics here, right? No, I am excited about this. And one of the things I'm really, really excited about is this is the start of our lecture series. This is something that I've been kind of envisioning for a while. One of the things that I think is really important is to bring context to different topics. And some of us have been in college recently. Some of us have been in school a little less recently. I think you were in school yesterday, but or maybe this morning. But we're joined by Dr. Dalton. He is a professor of economics here at Wake Forest University, and hopefully he's going to share some concepts, some themes. And do you want to tell everyone just a little bit about yourself?
Yeah, sure, absolutely. So as Matt said, my name is John Dalton. Before I get into too much detail, though, of course, I want to thank you for having me today. Very grateful to see so many faces. As you can imagine, I don't tire of speaking about economics. I could do this all day. Professor John Dalton, just up the hill at Wake Forest University. Been a professor of economics at Wake Forest since 2010. I regularly teach macroeconomics and international trade. Macroeconomics is a study of the economy at the high level. Think total unemployment, inflation, how the economy grows or doesn't grow, taxing and spending in the form of fiscal policy and monetary policy. And then international trade is both a study of the theory and the actual patterns in the data of how goods move around the entire world. So, as you can imagine, pretty boring topics these days and not much to talk about, which is, of course, not the case. Our students come into class eager to learn all of the things that are going on around them. The past year in particular with tariffs, for example, really exciting time in the classroom, not so exciting outside of the classroom. Prior to Wake Forest, I did my PhD at the University of Minnesota. And when I was at the University of Minnesota, I spent 4 years at the Federal Reserve Bank of Minneapolis. I was at the Federal Reserve Bank of Minneapolis during 2007, 2008, the subprime mortgage crisis. Again, a fascinating place to be as someone learning and practicing economics, not so much as a citizen. Most vivid memory from that time in the Federal Reserve Bank was on the floor of the research department, going around after the collapse of Lehman Brothers and seeing all the economists on the phone, which on a regular day they had not been on a phone. And they were, of course, taking calls from people in the press and around the world, trying to get a sense of what was happening. Now, it's such a vivid memory because an important part of being an economist, being a professor, is communicating your expertise about what's going on in the world. There's smart people everywhere. We just know different things. So hopefully I'll be able to do that with you today. The last little bit, Matt, is that I'm not a local boy, but I'm a regional boy. So I grew up in the Southeast. And so I really targeted universities in the Southeast and North Carolina in particular. I did my undergrad just down the road in Chapel Hill. And so coming to Wake Forest was a type of sort of coming home after graduate school.
Well, we're glad to have you. Yeah. I'm going to open us up with, I'm going to ask some questions, and at the end, hopefully we'll have time and we can do a little Q&A. But the first question I have for you would be, from your perspective as an economist, what feels fundamentally different now than, say, 10 to 20 years ago?
Well, you could maybe need to even stretch it a little further back. So I mentioned 2007, 2008 and being at the Fed, because that's really the big turning point for understanding what's different nowadays. And I think a big thing that's different now is just sort of the quality of our governing institutions. So one of the big things, that's both in terms of bad policy, but also just the inability to use government to solve problems. Kind of both sides of the aisle across administrations used to hear in commentary after the subprime mortgage crisis, well, what's going to happen to the economy over the long term? And economists would say, well, this is a crisis. This is a temporary thing. The economy is, quote, fundamentally sound. So you would oftentimes hear this fundamentally sound. And there were good reasons to say that. The United States is a well-functioning market economy. We have relatively good institutions. You put more people in the United States, you get economic economic growth that had been true for the past 100 plus years. But one of the things that changed after the subprime mortgage crisis is that we got off of what economists call their trend growth line. So if you map out in a picture of what the size of the US economy looks like, it follows a trend over time. There's fluctuations around that trend, but we kind of got knocked off that trend line. That's been a big concern of economists. Well, how did we get knocked off? Because all the prior crises, you just went right back up afterwards. And so getting off that trend line, how did that happen? There's a lot of competing explanations for how that happened. But one of the things that has become clearer in the times since 2007 and 2008 is that our institutions are not as functioning as well as they had prior to that.
So looking forward then, uncertainty, it feels like we're in a period of a lot of uncertainty. There's a lot less stability than there was. So if you look at that shift from 2007 on, taking it to today, do you feel like we're on a new trend line? Do you see that continuing? Do you see anything shifting with this administration, upcoming midterms? What impact do you think that's going to have?
Wow. That's the main question right now in terms of politics and maybe the economy in the United States. I mean, there's a couple things to point out. One is that, don't forget the midterms. Things can change drastically in the midterms in terms of what's happening in the executive branch of government. The tariffs are a really big story about the last year. One of the main effects from the tariffs, which I guess you're alluding to, is the massive amount of uncertainty. It's not the case that tariffs necessarily have to be accompanied with uncertainty. It's simply how they've been implemented, where it's a new rate, depending on the week, depending on the month, and we get all these conflicting stories that come out. I was down in Charlotte just a couple of weeks ago giving a talk, and the organization that I was with was trying to navigate this uncertainty for their own business. And that was one of the key things that they were focusing on, as opposed to, for example, say inflation, which if you look back at this time period or a little earlier last spring, inflation was the big thing that people would talk about was going to happen from tariffs. And it's really the uncertainty. So I guess to wrap up, to answer your question most directly, if a change in administration happens, in the next presidential election, it's probably not going to be so chaotic, right? That's not a political statement. That's just about, how, of course, the current administration operates. So you would imagine in an administration that was not as chaotic, then you wouldn't have as much uncertainty. It still could be the case that a different administration might have bad policies or maybe even worse economic policies. It's just unlikely to be accompanied with the amount of uncertainty.
So when you think about kind of the global side of things, take a macro view for just 1 minute. How would you say, whether we're talking about geopolitical conflict, where we're talking about trade policy, any kind of demographic shifts, how does that realistically flow into the U.S. markets? Like, how does that ultimately impact the U.S. markets?
In a lot of ways, two maybe main things to point out is the first, and this is such a cliche or a truism these days, we live in a global world, right? We live in a global world. But that's a cliche or truism for a lot of reasons. We've become more interconnected, obviously through the internet and thinking about the flow of information, but we've also become more interconnected by the movement of goods over time. So that's international trade, the movement of financial flows over time, and of course, people, which is one that oftentimes isn't talked about in this context, but it's really important. Of course, we all know about, because one of the main reasons that COVID-19 spread as quickly as it did was because of the movement of people through airplane transportation. In a world where you did not have airplane transportation, you would not have had the virus spread as quickly as it actually did. So we just live in a globalized world, which is a way of saying things that happen abroad, they will bounce back to the United States and have an effect on markets or investment performance in the United States. The second really big thing, I think, is to remember that if you add up or if you measure the total amount of economic activity in the global economy at any one period of time, that is global GDP, and you look at the United States' share of that global GDP, it has over our lifetimes steadily been declining from its peak post-World War II to its current level of about 25%. So that's simply a way of saying that relatively, the United States economy is less important than it has been previously. Still absolutely very important, but that means that shocks that emanate from abroad will have relatively more importance than they had previously. The example that I like to give these days is a major source of geopolitical risk at the moment is the Chinese real estate market. So you may or may not know much about this. The Chinese real estate market is highly leveraged. There's lots of debt. It's being propped up by government assistance. If there were a crisis that actually emerged in Chinese real estate, that would have an enormous effect on us here in the United States, because a real estate crisis in China, just like the subprime mortgage crisis I mentioned of the United States, would affect household and firm balance sheets, would impact everything that they do, including buying things from us. But that's not the case, just real quick, Matt.
Yeah.
That's not the case if we were talking about 1970s China, right? So a real estate collapse in 1970s China, pre-Nixon, for example, would not have the same effects as one nowadays. And that's just really seeing China's outsized role in the world relative to that period.
So that brings up a question then. Why, if I'm sitting here, I understand what you're saying, but I'm going to put myself in the somebody's seat and go, wait a minute. You just said the Chinese real estate is being propped up by the Chinese government. How does that affect my household? Can you maybe give a little bit of an explanation of the through line of there? Obviously, there's ripple effects,
right?
But how does that actually lend to someone sitting in this position? Because one of the things I hope that folks take away from this is maybe a little better understanding of economics in general. And I'm going to ask you a few questions kind of broadly about that, but also why it matters. And something that I think is so important is connecting the big picture to the practical. Mm-hmm. So when you say the Chinese real estate, if I'm sitting here going, wait a minute, what does this matter to me? Or why does it affect me?
Give you two concrete examples of how it could affect both at sort of a high level and then at a low level. At the low level, it's always useful to just put yourselves in the shoes of the people that you're thinking about. So imagine that real estate collapses in China and the value of the real estate goes down. All right. So the value of the real estate goes down. Maybe some banks go bust because they have some outstanding loans that can't be repaid. So what does a bank do when it has a bad loan portfolio? It's got to fire people, right? We don't need as many loan officers. We don't need as many tellers. And so now you've got people who are unemployed. All right. So they're unemployed. They're still in China. They're not affecting us. So how do they start affecting us? They buy fewer things. How many things do you go out in terms of your discretionary income and buy when you're unemployed? No, you tighten the belt. You pull back on your discretionary purchases. So they buy fewer things, including things from the United States. So there's lots of things, despite what you hear in the news, that we export to to China, excuse me. And so Chinese households and firms buying fewer things means that American companies and American workers are selling fewer things to China, which means that the revenue that those American firms and workers income starts to go down. And so then you might have effects there where the manufacturing plant in the United States says, well, we don't have as many orders coming out of China. So now we gotta cut back and we need to lay some people off. Well, that might then affect you later down the line as someone who might hold equities in that manufacturing company, because then they pay a lower dividend that year, or their profitability isn't as high and their stock price goes down, et cetera. That's at a low level. The high level is thinking about the Chinese government. If the Chinese government has to spend more resources on bailing out troubled firms domestically, it has less to spend on things like U.S. Treasuries, which China buys fewer U.S. Treasuries than it did, say, 10 years ago, but it's still a major purchaser of Treasuries. And the sale of U.S. Treasuries, which are just IOU pieces of paper that the government creates as a way of financing its current expenditure. So if there are fewer people buying those IOUs, then that means we get less money spent on favorite government program X, Y, and Z, right? So the building of military equipment or roads or medical expenditure, et cetera, goes down. And then that works its way through the economy.
Well, let's zoom in just a little bit, because I know North Carolina and the Southeast is an area that you've spent a lot of time and research on. So are there any kind of economic trends that you're seeing that are particularly relevant to North Carolina and the Southeast?
I am so bullish on North Carolina. I'm so bullish on North Carolina.
Why?
I'll give you a bunch of reasons. First, I want to say just sort of a fundamental point. You may have heard the expression voting with your feet. So when you see people, they move, they vote with their feet. One of the things that you've seen, particularly over the past 5 years, is an enormous amount of people moving into North Carolina from other places in the United States. Love this data. I don't know if you've seen this U-Haul data. So the U-Haul every year, they publish this data that shows where U-Hauls moved around the country. There's other data that supports this, but it's really neat because every time they release this annual report, it always makes the news. The one for last year made the news maybe a couple weeks ago. And out of the past 5 years, North Carolina has been the third highest state for people moving into it. Texas and Florida get more people than North Carolina, but North Carolina is the third highest state. People in the United States are voting with their feet to move to places like Texas and Florida and North Carolina. So that in and of itself is a great signal for the long-term prospects of North Carolina. So then you can ask the question, well, why is that the case? North Carolina has lots of great amenities. One of our big strengths is that we have, like Winston-Salem, we have many mid-sized cities. Sometimes you can get a problem where a locale, a state is dominated by one giant city in particular, because however the fortunes of that one giant city go determine the rest of the state. But we always have lots of competition between Greensboro and Winston-Salem and Asheville and Charlotte and Raleigh and Durham, all of these places that are competing for businesses to move in, for people to move in, et cetera. And that competition is really, really healthy. We've got the good weather, the mountains and the beach. We always tell job candidates that about when they come to Wake Forest, but that's very real. People like to have good amenities. We have good schools. We have great universities. We've got good healthcare infrastructure. And there's a lot of things going really, really well with North Carolina. We're kind of in terms of, I mentioned the governing institutions is a big concern of mine at the beginning. North Carolina is kind of middle of the road. We're not too far one way, too far the other, both in terms of the political parties dominating for such a long period of time, but also the actual policies that are enacted. And one of the things that you unfortunately see in the U-Haul and the moving data is where people are moving from. So the top 3 states to lose population in that data are New York, California, and Illinois. And these are states that in the past decade have had pretty bad governance, and that's why you see people moving. So one of our biggest risks going forward, I think, in North Carolina is that we do it ourselves. We undermine North Carolina ourselves if we go down the similar road of similarly bad policies. It can be hard to prevent that because these policies, of course, they unfold over time. It's not just you see the effects immediately. So the fact that these states are hemorrhaging so many people has been decades in the making, not easy to reverse.
I think if you look at Forsyth County schools and some of the way their budgeting issues have gone and their mismanagement of funds, I think this speaks to the fallout of policy affecting things over time.
That's right.
Yeah. Let me ask you this. When you think about regional economies, kind of like ours, how do they tend to weather economic slowdowns differently than a national average? Or because you see certain resiliency in certain areas, but also we know that certain sectors get hit harder than others. So when you think about North Carolina or the Southeast in general, what kind of sectors do you see being predominant? And then what would be the strength or the resilience? And then the potential weakness or an area that would be cause for concern?
I'm going to answer that question, but before I do that, I'm going to back up and I'm going to
Okay.
talk about your previous question.
Fire away.
I told Matt and Kristen this in our preparation. I love talking about Mebane. I don't know if you've been to Mebane lately. Mebane is an amazing place, and it's a perfect example of what I've just been talking about with North Carolina and why I'm so bullish on North Carolina. I joke. My wife is also an economics professor. You can imagine our dinner table conversations. Our 2 young kids trying to keep up, but she thinks I'm crazy when I say it. I always say Mebane is the future. The fact that a place like Mebane can grow so crazy like it's growing is a testament to the strength of North Carolina. And Mebane is, of course, positioned between the Triad and the Triangle and benefits enormously from that location. But next time you're going down 40 towards the Triangle, stop at Mebane. In the future, you will, because you'll stop at Buc-ee's. But there's so much going on in Mebane. I go there every few weeks, because there's a bookstore I like going to there. But it's a healthy sign to see communities like Mebane, and you could pick more communities, different communities than Mebane all up and down the interstates. But it's a really healthy sign to see a place like Mebane thriving as it is today.
So we see this a lot in different stocks. And I'll point to Google. Folks saw Google earlier this week. They announced they're spending more on AI. They beat their earnings. Everything's great. And yet stock price declines. That speaks more to emotion than it does to the underlying data. So why is it that the markets will sometimes perform well, in your opinion, when the economic data may not be as positive or as robust?
Okay, so the reason that that can happen is you should think of at the highest level of the economy, there's just a lot of stuff going on. So
Right.
there's horse races going on between lots of different factors. The past year is a great example, say sort of like just general stock market performance in the midst of all of this discussion about tariffs. Tariffs are unambiguously bad. When you import a container ship at the port of Wilmington and you tack on a sales tax, it's going to have all the effects that we know sales taxes have. And that's essentially what a tariff is. One of the main things that happens with tariffs is they get passed through to consumers. So you can imagine that a firm in North Carolina is importing something at the port of Wilmington, and now the customs official says you got to pay this elevated rate because we've got this new tariff. They just don't sit idly by and eat that. They pass it on to the consumers, and that's why you see the prices start to increase on the shelves. Okay, so why didn't the economy just sort of like collapse or just go haywire the past year? Was because we're having this AI boom at the same time. It turns out the AI boom is so much bigger in terms of magnitudes than the effects of tariffs, because even though the United States, if you look at the total value of all the exports and imports that we do, is the largest trader internationally, we are one of the most closed economies in the world. What I mean by closed is if you take that number, exports plus imports, and you divide it by the total value of all the goods and services being produced in the United States, the GDP. If you take that number and you rank it across countries around the world, we're consistently one of the most closed economies in the world. And the reason being is because there's simply so much domestic activity that takes place in the United States that trade relative to that is just simply small. So any shock to the trade sector, yes, it can have an effect, but it can very easily be overwhelmed by something like an enormous investment boom that's happening in AI. So you can get these sort of contradictory signals, that emerge when you're looking at any one particular piece of news. It's a good reason to try to tune the noise out in many important respects. But I think that helps explain in terms of the past year, in terms of thinking about which of these signals is most important. To return to your previous question, which I didn't answer real quick. So if you think about regional economies and how regional economies respond relative to the total economy, and if we think more concretely about the case here in North Carolina, how would North Carolina differ from maybe what's going on nationally? So North Carolina, and this is true of most states, North Carolina is going to be reacting in an average way. So North Carolina resembles that, what I mean by that, resembles the average economic performance across the United States. Now, the reason that has happened, that actually has happened over our lifetime. So states have become more similar in their economic activity. States used to be more different in terms of, okay, the car sector is here. So if something hits the car sector, then you better bet that Michigan is in trouble. That is less so today because we have become more similar across states. A relatively recent counterexample, but it's an exception, it's the exception that proves the rule, is what happened in North Dakota about 10 years ago, more than that, maybe it's about 15 years ago, with fracking. So anytime you look at state level economic performance over that time period across the United States, you're going to see North Dakota is just way out there by themselves. So North Dakota is just growing like crazy. What's going on in North Carolina? And if you look at that data without actually knowing that fracking was taking place, then you would think, well, yeah, North Dakota is just the economic future, the economic engine of the United States. No, North Dakota was just so different than the rest of the states that it benefited enormously from fracking. So in terms of thinking about how North Carolina might respond to different shocks, not so different from just the national average.
I'm glad that you say that was a kind of a deviation, because after the last couple of weeks, I don't know if I'd want to move to North Dakota. I don't know about anybody else, snow and everything else. I like it here a little bit more. Well, let me ask you this, because you mentioned AI, and I think you've got your early adopters, you've got your kind of your large group, you've got your laggers, and then you got your few folks that are never going to adopt any technology, right? I'm sure we all know somebody who had to be the first person with a flat screen TV. Before anybody else had it, they had it. And then before you know it, it became more common, prices are down, a lot of them have them. And
Or
I'm sure
those
you know
people
somebody who just got one.
still don't have flat screen TVs or
Yeah.
any TV, actually.
They're out there, and there's some people like that. So when you look at AI, and for those of you that don't know, he wrote a phenomenal book. I highly recommend reading it, and it was all about creative disruption. We can talk about that because I think AI is going to create a lot, but it's also going to be a disruption. So can you speak kind of on the large scale, not getting into which model you like or anything else, but what is this impact that AI is having, and where do you see it maybe being overblown? Do you see it being Terminator? Is this more of a tool that we're going to use to make more efficient spreadsheets? Where do you see this going?
Okay, so let me start at the highest possible level. The first thing to say is it's too early to know. This is not very old. It's a relatively recent innovation. We don't, in an empirical way, know because we don't have the data to see how it's starting to really affect things. That being said, when you look across the history of innovations and think just in our own lives about the history of innovation, it just seems big. It seems big, like internet big or bigger than the internet. So I think our kind of assumption, until proven otherwise, should be it's going to be big. It's going to have a major effect. We do have a little bit of data so far to be able to know, for example, how much AI is being used by particular firms, that there is variation across industries. You've probably seen anecdotally that AI seems like it's affecting white collar work more so than blue collar work. So that's true in the data. So if you look, for example, lawyers, accountants, financial advising firms are a bit different because they're constrained by regulations and how much they can use the AI, but eventually they'll use AI, I'm guessing, in big ways as well. Professors, for example, media and information sectors, all of these groups are heavily using AI. Construction sector, not so much. Agricultural sector, not so much. So there's lots of variation across the sectors. So one clue, if we think about our own backyard here in North Carolina, is, well, do we have a lot of people working in those sectors that are more heavily using AI? And the answer is it's kind of mixed. In some very important ways, we do not have sectors like the information sector, which information sector includes, importantly, like media and the news and such. We do not have as many workers working in AI. So you may have seen, for example, a bunch of layoffs at the Washington Post. You're probably not going to see like massive layoffs in that sector affecting North Carolina, right? Because we're not as heavily concentrated in that sector. So there's variation. There's variation across it. At the same time, it's a technology which will slowly start to affect all of us, even the blue collar workers. And so the test will be when you start seeing AI really affecting industries and firms that you don't associate with AI, that's when it's starting to have a really big effect. The example I like to give is like landscapers and gardeners. So what is going to differentiate landscaping firms, maybe already, but certainly 5-10 years from now, it's going to be the guy, and it's mostly guys who run them, right? It's going to be the guy who brings along the tablet and he's talking with you about the new landscaping you want to do or how you want to lay out the stonework in the garden in the backyard. And he takes an image with his tablet of your backyard. And then he just pulls up the AI function on the tablet and says, okay, do you want it built in like an English cottage style? You want it built in like a French style? You want to do it in this style? And he'll have the AI create the image, all the planting that you want. I don't like that plant. Get rid of that one. That's not a native species. I don't like this one, whatever. And he'll just put them all there on the tablet for you. And he will be working alongside with the AI to create the vision that you have for the landscaping. And then they will come in with their team and they'll do the blue collar work. We'll do the manual labor to actually put it in. So when you start seeing stuff like that, which you will see stuff like that's just inevitable. That's when you know, okay, yeah, this is starting to have a really big effect. And it presumably is going to be a good thing in lots of different ways. It's going to increase the profitability of that landscaping firm. They're, of course, going to drive out a bunch of their competitors in the market that are not using that technology, but those people will do other things because they're people, they have ideas. Maybe that landscaping gig didn't work out and they'll start that restaurant they always wanted to do, or they'll do something else, right? So that adjustment period may be painful for those who are negatively affected by it, but that's just how the market works. People move in and out of jobs all the time.
Can I ask you a question? This isn't maybe directly related to economics, but as a professor, you deal with a lot of students. You got these large language models. I was reminded, I took a course in college and it was an English class, and we had 16 different reading approaches, and we had to read The Great Gatsby 16 times. I had to write 16 different papers on The Great Gatsby. I don't think my professor cared to read 40 papers on The Great Gatsby 16 times because any of us had brilliant insights, but it was about having the student learn, apply what you've learned, the act of writing. I did not write any insightful things about The Great Gatsby. I'll go ahead and warn you now. But do you feel like students are using AI to their own detriment, or are some of them getting value out of it? Because I'm concerned about the youth of our nation and where things are headed from an education perspective.
Absolutely. Though what I think will happen, and I'll give you a bunch of examples. I think what we'll have is a cohort effect. So that means the current students who are on the cusp of the innovation and are the first ones to use AI, they'll probably be the ones that are most negatively affected. But eventually we're going to figure it out, and we're going to figure out how to use AI alongside with traditional learning. I say to myself frequently, think students currently in college, this is the cell phone, remote learning, Zoom, and now AI generation. I think you're going to see enormous effects on educational outcomes in terms of the skills they actually have from all three of those shocks back to back to back going forward. Because the current problem is, to use the English department example, is that the take-home essay is obsolete percent. There is no take-home essay. You cannot do that. There are attempts to try to use AI to put the essay in to see if an AI wrote the essay, but the cat is out of the bag in that sense. And so our colleagues in the English department and the university, they're an example of a department that really have the worst part of it. We rarely give take-home essays in economics courses. I've never done that in any of my classes. I don't know my colleagues that do that. We use a lot of math in our classes, and so in-class tests are the way that we assess learning. And I would say that has not been so negatively affected by AI. My students are certainly using it. So for the first time last semester, I had a student take all of my notes on the board, and he dumped it into the AI, and he had the AI write like a short textbook around it because he was having trouble getting the context for my notes. And then he used that AI augmented version of my notes, which of course I did not give him permission to do. That's a whole nother problem. And then he used that to generate multiple choice questions that he could then study from for the exam. But here's the problem. He came to my office hours and he had like 50 multiple choice questions. So what do these look like, Professor Dalton? I mean, I can't sit there and read through 50
Right.
AI generated multiple choice questions. So there was the problem, which I told him, I mean, okay, yeah, these few that I'm looking at, that they seem good, but beware. I mean, this may not be correct that the AI is generating this information. We probably know about hallucinations with AI.
Yeah.
So I think it certainly is going to be disruptive, but that's not so dissimilar from other innovations like the internet, which we're still dealing with the disruption from the internet, I think, in many really important ways. I think AI is just going to be another example of this.
So I think it's going to have disruption in so many different areas. But with that, we're going to have a period of economic transition. So historically, what has rewarded more patient investors during those periods of economic transition?
One thing is maybe to not panic, because you probably know that emotion can lead to bad decisions.
Correct.
And the other thing is, certainly if you're well diversified, which would be one strategy to pursue, then you don't have all your eggs in one basket. One great thing about living in the United States in terms of our investment lives is that we are able to invest in the United States as a whole. So if you're investing in many different stocks, for example, and you have some diversification, you're essentially betting on the American marketplace, on the American work, on American capitalism. So So if any one sector is wiped out, or portions of sectors like the landscape guys that don't actually innovate, well, then that's going to be compensated by the ones that do. And this is in some ways another example of when you add everything up, on the whole, everything is I think going to be fine. You're still going to have economic growth in general. Let me go back to the first thing I said, though, about like the don't panic, with a story that illustrates this really well. So I started the conversation today saying I was at the Federal Reserve Bank of Minneapolis in 2007 and 2008. So what do you think lots of households in the United States did during the subprime mortgage crisis when it came to their personal finances? They sold their stock positions, or they sold parts of their stock positions. Gallup, which you know Gallup, they do the polls, right? So Gallup is the best source of data for this. They ask households a question. They've been asking this for years. Do you own U.S. stocks in any form? So it might be you own a single stock, you might own a mutual fund, an index fund, et cetera. And so they track the percentage of U.S. households that own stocks. So that percentage of U.S. households that own stocks dropped dramatically after 2007, 2008, as people exited the market. And that had lasting consequences for two reasons. One, they didn't get back into the market. So Gallup kept asking that question, and the percentage of households that owned U.S. stocks, it crept up, but it only reached the pre-2007, 2008 numbers, say, by the beginning of Trump 1's administration, around that time. So it took a really long time for people to get back into the market. And if you watched, of course, what happened to the stock market in terms of its valuation over that time period, it, of course, bounced back and valuations increased enormously. Exiting the market prevented a lot of households from taking advantage of the gains that happened after that initial shock.
So I think you also saw a lot of people during that time period shifted to precious metals, gold in particular. Gold prices, you saw them spike in 2012, 2013. Then they steadily declined. They didn't come back to kind of parity until around 2020. Now we're seeing silver has shot up dramatically. Gold has shot up dramatically. Looking at that, do you feel like this is a carbon copy of what happened previously, where people are fleeing to safety because they're concerned? Is this people just looking for a hedge? When you look at that, I understand market risk is a little bit different from an economics perspective than on an individual perspective. But what do you see when you look at the precious metals market currently?
So I think it's a great question. I think it can connect to several different things that I've been talking about, particularly the concern about the governing institutions at the beginning. So I kind of view the recent, it's in the past year, rise in precious metals prices, gold and now silver, starting to catch up as a canary in a coal mine. When you think about all the different places that you could put your money in, your hard-earned savings, gold and silver is not the first place that comes to mind, right? You put it in productive assets like stocks and bonds, or maybe put it into housing, or maybe even put it into cash where you earn a little bit of interest in a money market account, for example. But the fact that you see the values of silver and gold increasing so much is telling you that people are fleeing from those traditional assets. And then the question comes, well, why is that? Why is that? They must be afraid of something. So that's not a statement that you should go out and buy a bunch of gold and silver. It's simply this is what's happening with the price. Let's take that as information that we can use in terms of the state of the world. Now, one of the things that has been driving that price up, which draws with this distinction about like an individual versus big institutions, is that since COVID, shortly afterwards, in terms of some policies that took place under the previous administration, central banks started buying gold around the world like crazy. Think like the Ukrainian war. How would Russia like to have a big stock of gold, knowing that it was going to invade Ukraine? So central banks around the world, the Polish central bank, the Chinese central bank, the Russian central bank, have been big purchasers of gold and precious metals in general. now and over the past few years, which is contributing to that rise in that price. But of course, why are they doing that? So one of the reasons they're doing that is that they are fleeing US treasuries, or they're trying to create a source of stability outside of a dollar denominated world, which is again a way of saying like our relative power is declining. So it's concerning to see that price increasing the way that has increased and it points to some larger problems and maybe in the underlying structure of the economy.
Do you feel that the current administration's attempts to weaken the dollar are having any impact on that as well?
In terms of the impacts are interesting to think about, like a weaker dollar. So there's a lot of let me say a couple things about just a weaker dollar. So there's been a lot of concern if you look in the news about de-dollarization. That's that process by which foreign companies or entities, as I've been describing, might move out of their dollar holdings and put their money in something else like gold. And so there's big concern in 2025 about de-dollarization, whether the dollar would not be a reserve currency. So the way that you can understand this, I think, is very simple. If you think about like a central bank, for example, or you could think about like yourself as an investor, and you choose to hold a bunch of different currencies. Most of us probably only have dollars, right? Some of us might have dollars and silver and gold. But when you think about other countries and central banks, they have Japanese yen, they have euros, they have Chinese yuan, they have US dollars, they have gold, etc. So it's not the case that the US is going to lose its reserve status. It may lose, and this is the point, its market share, some of its market share. So if you look at how much yen versus Chinese yuan versus euros versus dollars that a central bank might hold, they may decrease the amount of dollars that they hold relative to something else. But it's not the case that the US is going to lose its reserve currency status. Okay, return to your direct question. Weak dollar. What does a weak dollar do? So you may know that the Treasury Secretary in particular has been out the past year talking about the policy of the administration is to try to achieve a weak dollar. So if you have a weak dollar, one of the benefits that you have from that, and this is why the Treasury Secretary goes out and pushes this, is that it makes everything that you can buy in the United States, that includes coming to the United States as a tourism or buying goods and services from US firms, becomes cheaper. Why does it become cheaper? Because you have euros and now it's cheaper to buy dollars. So you take those euros, you exchange it for dollars, you get more dollars. And now you have dollars, you only have certain places to put it. And one of the places you can put it is buying goods and services from US companies. So the policy of trying to have a weak dollar is trying to stimulate exports. Of course, there's other side of that. It's now more expensive for people in the United States to buy things from Europe because now euros are more expensive. It takes more of your dollars to exchange for fewer euros, and then you have fewer euros to buy things in Europe with. So that would decrease the amount of imports that you can take. So it's not that policy doesn't come without cost. Maybe the last thing to say, Matt, is oftentimes this is a bit imperfect, but you'll hear this said a lot, that the value of a country's currency is like the country's stock price. So if the value of that currency is really high, then that means people have a lot of confidence in that country. And so if it goes down and it weakens, and that's like the stock price of the country going down. And there's some truth to that. And so it's kind of a mixed bag about what the effects of a weak dollar would be.
So one last, because you brought up a question that I have. When you think about like the relative strength of the stock market versus the relative strength of an economy, I think oftentimes we think, well, if the market's up, that means the economy's strong. If the market's down, that means the economy's weak. That's not necessarily true. Do you mind speaking to that just a little bit?
Yeah. So one way that you can see this, I'll mention this term if you know it. If you don't, it's no big deal. I won't dwell on it. A K-shaped recession is essentially this idea that you can have different groups in the economy, that one group is doing really well and one group is doing really bad.
Right.
And so, for example, if you look at household income in the United States, you may have often hear, this is maybe an important fact to know. You may often hear about the decline of the middle class. It's not because the decline that the middle class there's fewer middle class households. It's that more middle class households are now characterized as upper middle class. So the upper middle class in the United States, those households get hit harder and harder and harder. And so it can look like in certain industries, in certain sectors, for certain households, that things are really bad, but at the same time, you have these really thriving parts of the economy, and that might manifest itself in the stock market, for example, because low-income households, of course, are not invested in the stock market. They're the ones answering those Gallup poll questions, not the only ones, but some of the ones answering those Gallup poll questions. No, I do not own any stocks.
So then let me ask you this. What should thoughtful investors focus on and what kind of things should they tune out? Because there's a lot of noise in the media. There's a lot of information. I would say we're in an information age. You can hear all kinds of things. Where should people be putting their focus and what should they say? Maybe I don't need to know exactly what's going on with insert whatever.
So now I maybe take my economist hat off for a minute and put on my own personal philosophy hat, because that question goes, I think, beyond just the economic expertise. I think my answer, though, is an answer to a lot of the uncertainty and chaos that people probably are feeling in our world with the internet and social media and the polarization that's happened in our politics as well. And that is tend your own garden. You can't control what's happening with the stock market. You may have heard the expression, you can't fight the Fed. There's nothing you can do about the inflation. You can only control the things that are within your own power. So if inflation is going to continue and you're not getting raises at work, or your portfolio is not performing because maybe you're more heavily invested in bonds, for example, well, maybe that means you need to tighten the belt in other places in just your household budget, and maybe you don't spend on a category that you maybe spent before, and you do the things that you need to do for your own household, your own life, to make sure that that world is secure and strong and has the best foundation that it has amidst all of this seeming chaos that's going on around us.
So I have one last question. Well, okay, a couple questions, and then I do want to get some questions from the audience. So if you guys have questions or something, just raise your hand and we'll try and address them. But one thing that I've seen is we're seeing an increase of the impact of consolidation in the stock market. So you're seeing a lot of mergers and acquisitions. You're seeing less IPOs. There's some interesting ones that are coming up. SpaceX being one of them. But you're seeing less IPOs than we've seen in the past. So you have less stocks coming to the market. At the same time, you're seeing a lot more private equity coming in from a minority partnership standpoint. And so you're seeing opportunity in the alternative investment space. When you see that, what does that make you think? Because one of the concerns that I have is for the vast majority of investors, the lion's share of it at least is inside of your 401ks, right? And so for most folks, you're limited with your investment strategies to just what the 401k offers. And so what you have is broad-based index funds. That's your choice. So we're seeing more dollars chasing fewer stocks. What do you see? Does that drive more volatility? Does it give you reason for pause or concern? Or is that just where the nature is now and we accept it and move forward?
Yeah, we may just have to accept it and move forward. And the reason being is because although this is how the world is now, this has been unfolding, unfortunately, for decades.
Correct.
So the amount of new IPOs that enter in the market has been going down, 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 down. And the reason, or the main reason that you hear cited, is that the regulatory burden with being a public company, not just the paperwork and the cost of actually doing the IPO, but then having the public scrutiny of the regulators, has increased so much over time. This is an example of our institutions being of lower quality than they used to be. So companies' response has been, I'm not going to deal with that. I'm not actually going to go and list the company publicly. And one of the effects that you have alluded to is that if you only have access to those publicly traded companies, as most people do in their 401k plans, that you're getting a smaller and smaller share of the total market capitalization in the United States. And if you want to begin accessing a larger share of that, you have to have some special connections to be able to tap into private equity. And so I can't necessarily speak to volatility, but it is certainly true if, like, this traditional way of thinking about investing your personal finances is get a slice of American capitalism, you are now able to get less and less of a slice, less and less of a share of American capitalism than you have been previously. And I think that's bad. I think that's really bad. So part of the reason I think that the announcement that SpaceX would potentially be going public was so noteworthy is because we have so few of these giant IPOs that happen nowadays. Obviously, there's the Elon Musk thing that made it newsworthy as well. So that's just like not a good sign. I mean, I would love to live in a world where our private companies would want to tap into the collective savings of the entire United States by going public. Unfortunately, that just doesn't happen as much. Now, that being said, it's not as bad as maybe that sounds. You can still get a big chunk of the market through those traditional means. It's simply a statement that the share that you're getting is declining over.
So I've asked a lot of questions. Does anyone have questions for Dr. Dalton that they'd like to ask? Fire away. And if you'll speak up, because it's a little echoey.
From the investment questions, major accounts with Paris T, distributions to this in Greensboro and Indian Trade. But aside from that, in tractor trailer driver and on coaching, I get to see a lot of things on the internet before I go to sleep. And some of those things are kind of direct from news reports in Japan, for example. How well their economy is doing. AI has obviously been around there much far longer than we live. And they're very successful, so forth. If their economy is doing really well, why is there not more focus on the way they're investing versus the way we're investing here? And we invest more into their markets, like they're investing.
So the question is, for those that couldn't hear, is why is there not more of a focus or an emphasis on international investing versus domestic investing? And he used the example of Japan and some of the growth they've seen in their economy recently. I'll let you speak to that. And
Sure.
And then I've got a few thoughts as well.
So although the U.S.'s share of world GDP has been declining over time, as I said, and we've become relatively a smaller share of the global economy, as I mentioned. If you think about the future prospects for economic growth and you look around the world, it can be kind of depressing. So you mentioned Japan, but Japan has been growing much, much slower than the United States, say over the past 25 years. Europe has essentially stopped growing since 2007 and 2008. It's a major problem in the in Europe. China is booming and has been for a long time, though it's kind of slowed down since COVID-19. Oh, and they're also ruled by a totalitarian government. So do you really want to invest that much in China?
Or do you trust the numbers entirely?
Or do you trust the numbers entirely? That's exactly right. So this is both a good and a bad thing of being in the United States. So like a good thing, okay, yes, we can bet on ourselves, and that's probably like a good bet. But it's bad because our world in which all economies are growing and flourishing is a much better world. Just a simple example of there's an innovation in another country, and then that innovation can spread, and then you can use that innovation here in the United States. And so I think part of the reason that you don't see more people investing in international companies is because of the experience since 2007, 2008 with many countries around the world. Of course, you may know that past performance is no indicator of future performance, and that international stocks in particular have been doing quite well lately. I don't have a crystal ball to say, where to go from here, but the United States has long been a good bet and will remain. There's the maybe more technical question. Some people will oftentimes say, well, do you really need to invest in an actual Japanese company? Can you just invest in an American company that sells a lot of things in international markets? Those American companies then have international exposure. So there's different philosophies in terms of constructing the portfolio about which way you go. You can, because we live in this globalized world, you can still capture international exposure through U.S. companies by themselves.
Yeah.
Great question, though.
I saw a question in the back.
Are you seeing anything like that? That they're seeing things like nature of term as far as bringing those issues back?
That's an excellent question. The short answer is no, not yet. I mean, maybe in the future, but I have a lot to say to that question. So I talk about this in my trade class a lot. For those of you who've lived in North Carolina for a long time, you probably know that. So know this: the big three that were majorly affected in North Carolina from international trade with China were textiles, furniture, and tobacco. All on the manufacturing side. We still have kind of the high end stuff like the furniture market and High Point, right? But it's the manufacturing jobs that get gutted. All right. So is that going to come back from tariffs? Now, if you listen to the administration's arguments in favor of tariffs, this is one of their main lines. We need to bring manufacturing back to the United States. I am highly skeptical, unfortunately, I will say, because I do think there should actually be more manufacturing in the United States for essential things like military equipment, for example, that we wouldn't want to outsource to other countries. But the reason that I think it's going to be hard bringing it back, and this is very important, it goes to my previous comment about trade being such a small share of U.S. economic activity. There are many things that determine whether or not a furniture company builds a plant in Hickory. Tariffs is only one of them. So there's also OSHA requirements, and there's EPA requirements, and there's local legislation that says, well, actually, we don't want that data center, and we don't want a data center. We also don't want a new factory either down the road, and we don't want this, and we don't want that. And tariffs are only one piece of that puzzle. So if I were a part of the administration, and there's some of this going on in terms of trying to change some of those types of restrictions, but that's only at the federal level. Remember, you also have the state level and then the locale, the municipality who may have these restrictions in place as well. It really needs to be a two-pronged strategy. If you want manufacturing to come back, it needs to not only be something like tariffs, it also needs to be, okay, we're going to do this, and this other thing to also help manufacturing. So again, I don't have a crystal ball, but my sense is the answer is going to be no to that question, because tariffs are only one of many things that determine whether or not you do manufacturing in North Carolina or elsewhere in the U.S.
All right. I think we've got time for maybe one more question, and then I've got a couple housekeeping items, but does anybody have any final questions for you? All right, fire away.
Rising national debt, I mean, adding $1 trillion or so, I don't know how much every year. The debt to GDP is rising. I think the interest payments on debt are greater than defense spending for the first time since 1934. And that's not even the worst part. The worst part is the unfunded liability of Social Security and Medicare. So that as more and more people retire and sicker and sicker, those costs are going to zoom too. And this is going to lead to some problems in the future. What you had to say about that?
I think we're on absolutely the same page and recognizing that as a major concern. When I said that silver and gold price appreciation would be like a canary in the coal mine, U.S. government debt is some of the toxic fumes that those canaries would be out there to sniff. So certainly when I say I have less confidence in governing institutions, a big thing I'm thinking about is U.S. federal government debt. We're currently running deficits that are like essentially wartime deficits. They're not like peacetime deficits. I didn't start under this administration. That's been going on since COVID-19. So it's very concerning that now that the pandemic has kind of gone away, that we're not able to return to a baseline expenditure that we had previously. And this is my concern when I say that previously the ability to make these hard collective decisions just doesn't seem there. This is an example of a hard collective decision that needs to be made. My concern, if you think about, that's a very high level thing. My concern is to think about on the more individual level. I say this reluctantly. American households are a lot poorer than they realize. They're a lot poorer than they realize because they have all of this federal government debt that ultimately they're responsible for paying back. What are we going to do about it? I'm afraid we're just going to kind of muddle along. I don't think we'll do really anything about it maybe, but we'll muddle through it and it'll have consequences that'll be at maybe just a drag on GDP at lower levels. It might be higher inflation. That's one of the things that governments tend to do as a way to solve that's a historical statement, to solve their problems with debt. They inflate the debt away. And so that's one of the things that if you put a lot of weight on government debt as a problem, you should probably put a lot of weight on inflation is going to be higher in the future. And there's things that you can do in terms of your own personal finances to hedge against that risk, to lower the risk that you would face from higher inflation to pay back the debt.
I will say, I think most of the people in this room have heard us talking about inflation for years in the office. And one of the reasons is because you have periods of high inflation, but I think we have this notion that, okay, we're going to get through it. We're not feeling it. We're not seeing that 8-9% increase in inflation. It's not a concern anymore. I would argue that this is the time we need to be planning and addressing for it, because inflation is something that we feel is inevitable. And so that's going to be a key component from a retirement planning perspective and from an estate planning perspective. I think we would all agree $100,000 doesn't go as far now as it did in 1985, right? And so when we think about the future, I think combating inflation is going to be key.
I know we're getting short on time, but let me say something directly to that. So the inflation rate has come down since its high during maybe like year 2 or so of the Biden administration, recent high. But still, if you look at current inflation rates, what are they, Matt? They're probably like right below 3%.
Yeah, it's right at 2.
Okay. So that number seems small compared to that period, but that number is 50% higher than the average rate during most of your lifetime. The average rate of inflation during most of our lifetimes has been 2%. So if we're talking 2.93%, that's 50% higher. So 3 sounds like a small number, but it's 50% higher compared to pre-COVID. So yes, you should still be concerned about inflation. I say that to you not to panic. I say that in part to start writing those letters. We need to get this under control.
Yeah. I would also say that having that diversified portfolio is one of the best hedges against inflation. Last thoughts. I'm gonna ask you one final question here, and this is more so for my own benefit than everyone else, but you can have it too. You mentioned a bookstore in Melbourne that you go to all the time. I read constantly. I read your book yesterday. So what are you reading right now, or what would you recommend that we all read?
So what I'm reading right now is a book it's a relatively recent book. It's called The Idea Machine by Joel Miller, The Idea Machine. It is all about how books as a technology are idea machines. That is, they spread and propagate ideas. So it's all, the first half of the book is about innovations in book technology. Think going from the scroll to the codex. If you haven't heard that term, the codex is what the book is nowadays. That is actually called a codex. And how would going from a scroll to a codex be so transformational? Imagine trying to flip through the pages of a book to find the passage that you like, and do that with the scroll, for example. That's a really different technology. And the second half of the book is all about how the ideas through the books have spread. And so just this morning on campus, I was reading, the last chapter I read was on Jefferson and Madison, about how Jefferson, when he was in Paris, bought all these books for Madison and sent them back to Madison. And if you go to Montpelier in Virginia, you can see this. You can go to the room where Madison had his books, and you can see the books he used to study to come up with all the debates about the Constitution. And so that's a fascinating way in which books have affected ideas.
That's excellent. There's another book, How the Irish Saved Civilization, that talks about, anyway, that's a great book for you too. I will say this. I heard a quote recently that I thought was fantastic. It said, "The man who doesn't read is no better off than the man who can't." So just if you want to read his book. But last thing, and everyone said, wait a minute. Or you can use AI to give you a synopsis of it. Just take the key takeaways. But before you leave, we do have a couple things here. There's a little housekeeping items. If you'll fill out a response form, now this is whether you're a client or not, it helps us kind of track attendance, and the more feedback we get, the better. My goal is for us to continue to make these events more beneficial for you, more valuable, more enjoyable. So if you've got feedback, if you loved something, please let us know. If you didn't like something, let us know. That kind of feedback's really helpful. If you're new to Semmax and interested in the work we do, we'd be more than happy to schedule a visit with you. Kristen and Taylor in the back, they can help facilitate that. Additionally, we have a few copies of Dr. Dalton's book here, Creative Destruction, and we're going to give those away, but we're going to do a drawing based on the response forms, okay? And lastly, you all see those beautiful centerpieces on the tables? If you will open your notebook, the Semmax notebook that we got you, a few of them have a gold sticker. If you see a gold sticker, congratulations, you win. You actually get to take that centerpiece home with you. So, good luck. I see you win. John, that doesn't get you off the hook. You still got to buy your own flowers. All right. But thank you so much for coming. I hope y'all have a wonderful day. All right. Thank you.